All right, well, the last article of the day is mortgage rates in U.S. slide below 7% for the first time since August. This is coming in from Bloomberg. Freddie Mac economist says a market could thaw in the coming year. Buyers are still confronting a lack of home for sales. But look, man, mortgage rates falling below 7% is a big deal because it's been the first time in months. We had flirting with 8s in October. But for specifically VA, which is what we do the most of, it's well below 7. It's not even below... It's so far below 7, it's in the high 5s.
Yeah,
in some cases.
Depending on your credit scores, it's in the, high 5 or low 6s.
Yeah.
Which is great.
Yeah. And I think that, the article cites here that borrowing costs have eased for 7 straight weeks, bringing rates down from a high of 7.79% average in October. And the decline raises the prospects that buyers sidelined by high interest rates costs may return, because now we're looking at the average of 6.95%. Which is 0.8% difference than where we were just 2 months ago. That is a very, very rapid change. But we've also seen the equivalent amount of change in the 10-year yield, going from 5% down to 4% again.
Yeah. As a matter of fact, I have another client that, we qualify them at $775,000. Okay. And it was at 7.375. And they're putting 20% down, 790 mid credit scores what they had. So I repriced that, and now they're all the way down to 6.375, a whole 4% lower. And that automatically got them to qualify to $860,000.
Whoa.
So $85,000 more, 75, 50.
Yeah, $85,000 more.
$85,000 more. And the payment was still, I want to say like $4 difference lower.
Dang. Okay, so let's go back over the math really quick. So they originally qualified for $775,000 at a rate of 7.375.
Correct.
Now the rates have gotten better. They are now at 6.375.
Yep.
And because of that, the cost equivalent of their monthly payment allows them to afford $85,000 more, which means now they can afford $860,000.
Correct.
Now, really quick pause. All of you who are talking about home prices falling and collapsing, this is why they cannot and will not, is because you have willing buyers who are going to go and tackle a home at $775,000 with a 7.375, and now will upbid their offer against other people because the rates have gone in their favor. This is also the thing that we were kind of forecasting and warning people. If the Fed starts cutting rates, whether it's now, if it's multiple times in 24, 25, this will continue happening. This is exactly the scenario that, when broadened and done by more and more volumes of people, is going to put price pressure on homes. And we're already seeing that reflected in the new conforming loan limits. Fannie Mae and Freddie Mac are basically admitting, everybody, that a 5.5% home price increase in the new year is either their catch-up provision or what they're forecasting we're looking at. This... Thank you for letting me give time here. Thank you for giving me the time to do this. This is why we've been saying this. This is going to happen because there's already pent-up demand. There's lack of supply. And when rates go down like this, people can afford more.
Well, this just gives more encouragement. It just encourages people more like, okay, we're going in the direction. Might as well just get it done. Yeah. And now I could afford more home because it puts you in a different pool.
Well, and you can outbid people. Yeah. Okay, so this same scenario, let's say someone, because again, this is just the example you're giving me right now.
Damn, you're excited, huh, Andy?
I am, because here's why. There are some people that were sidelined last year. They were sidelined because they're like, oh, either emotionally or psychologically, I don't want to jump in the housing game. Or mathematically, they were eliminated. So if this brings affordability, because these people didn't have to go to 860. Yeah. They could have saved their 775 purchase price or loan amount and gone down to 6.375 and saved, I don't know, $800 a month or $700, something ridiculous like that. So this opens up affordability for people who thought they were out, increases purchase price opportunity for people who are 100% in and committed no matter what the rate is. And it confirms and validates what we've been talking about. When rates go down, people are going to show up again. Yeah. They're already doing it.
So this is great news for a lot of people.
Do you think this is going to bring inventory? Because high rates
this is not
going to
bring. Yeah, exactly. Usually it's the other way around.
Well, that's what I'm saying.
And here's the thing. I don't think we're going to see inventory anytime soon. It's going to take a long time.
Okay, just to hear me out. What about the golden handcuffs argument, though? Because we've been talking about so many people that have like 2.5%, 3%, 4%. Now that like gap between 8 and 4 is like got down to the 6s, do you think that will now encourage some people to list?
Absolutely. I think once the rates start going down, it's going to give that encouragement.
So Lawrence Young, the chief economist from NAR, is saying we're going to see 6 to 7% interest rates all in 2024. It could be maybe just in the 5.5 to 6.5, honestly, because we're seeing VA below 6%. But I think that because we've had the reverse experience where when rates do go up, we see inventory show up.
Yeah.
Well, it didn't happen. So maybe we will see the opposite in the same way.
Yeah.
Well, when rates go down, inventory shows up. Because I think some of those handcuffs are going to break off for people.
And I actually say with the 3 rate cuts, if that does happen, I'm really thinking with the rates, they're going to be in the high 4s, low 5s.
Oh, wow.
That's what I'm thinking. If that's in general, if that does happen, the Fed does reduce the rates by 1.5%. I think that's what we'll start seeing.
Well, and I want to, and I have not said this on this show, but I think that one of the things that I know in my private surveying and researching for these kinds of talks, I know that the Fed needed to get their Fed funds rate higher than inflation and hold it there. So now that inflation is ducked below it and is held below it and is easing its way down, they're going to have room to notch themselves down too. And as long as they can keep that Fed funds rate higher than inflation, then we're likely to see lower mortgage rates as well. The 10-year yield will follow that lead, and so will the mortgage-backed security market.
Just need more homes. Let's go.
Just need more homes.
Come on, let's go. More homes. More homes.
Back to you, home builders. We need more homes still.
Come on, home builders. Yeah. Let's get this.
But again, it's okay. Quick thing is on home builders, this should also give them encouragement that if home prices are going to stay and people can afford more and rates are going down and people are thawing out and coming back to the market or re-entering the market to afford, guess what they should be doing? They should be building more homes. Yeah, I would think. But, I'm not a home builder. I'm just this guy talking on the show.
Yeah.
I hope someone writes something about that in the comments. Yeah, you are just a bald guy on the show. Pop up alone.
Hey, pop up alone.
Pop up alone. All right. Well, Memo, thank you so much for joining me here to talk about all this stuff today. Really excited. Lots of really cool things happening. Yeah. Finally, to have a whole year of just chaos and uncertainty and weird stuff talking about monetary policy and the Fed and all this like tech talk stuff. Really excited to talk about some of these things today. What was your favorite part of the show today?
My favorite part of the show is, once again, knowing that we can save people money, and we just got to continue to pay attention to people's situations. And then if we help them understand how to build, good savings, like let's just continue to pay more attention to these things right now in our clients.
Yeah. What's crazy to me is, several shows ago, you had an example of someone saving like $1,300 a month. Brian had an example of someone saving $1,200 a month. You give an example today of someone saving $548 a month. Even if someone's saving $300 a month, like that matters.
Yeah.
You cumulatively add that up. That's $3,600 a year. And in 5 years, that's $18,000. So, that really matters to people. And I'm really excited to hear more discussion, and I'm getting some interest in the comment box about the Mortgage Accelerator Calculator.
Yeah.
Look, as a mortgage company, our job is to sell you a loan. We don't have to show you how to pay off your house, but we love doing it. We love helping you save money and actually show you how to pay off your house so you don't need a loan.
And it's compounding. One thing that Albert Einstein came up with is compounding interest, right?
Yeah,
one of the best freaking things he could have ever invented there, or made us aware of.
Yeah.
Okay. And so the thing is, now that has a reverse compounding effect. When you're paying $500, remember, you're paying down as every month that you're paying down principal, interest starts reducing.
Yep, that's right.
So it has the reverse effect.
Accrued interest.
So all you're doing, we're teaching people how to utilize a compounding effect in a reverse way to benefit them and build equity.
And I don't mind being contrarian. I don't. I know it probably sounds counterintuitive. We're like, oh yeah, well you guys sell loans, you make money by doing loans. Yeah, we do. But
of course,
at the same time, if we can help people win, and that means for them paying off their house, whatever, like that's a great celebration too.
Yeah.
Doesn't always.
I mean, I do that. I pay $500 every month towards the principal.
Yeah.
I shared earlier last week that Tanya was all excited. Look how much we owe.
I know.
Practically nothing, which is great.
I know. That's crazy.
So
that's crazy. And you bought that house at the bottom. Oh my God.